Hey, what's up? It's Matt with MJ Gabel. Welcome back. I wanted to do a quick video today about the state of the diamond industry and the diamond market. So I know a couple months ago I put a video out about, I think, April or May numbers being down close to, I think, 15% across the board on diamonds. And that has not changed for June. They're continuing to see a fall in diamond prices, both in the natural goods and the lab-grown goods. So he received a press release from Rapaport earlier in the month, a few days ago, July 4th, regarding the diamond prices fall as retail slump continues. So overall, diamond prices in June fell about 2.4%, and the market slowdown continues. They're saying in June, as U.S. retail demand puts the midstream under pressure. So jewelers have avoided buying new inventory and are working on memoed goods. So jewelers are not necessarily buying loose goods or finished goods for inventory, and they're working off memo. Manufacturers also have maintained reduced polish production in the response of lower sales and thinner profit margins. So not only is the diamond market reduced, but jewelers are thinning their profit margins out to kind of stir things up and get some product moving. Dealer activity and trading is also slow amid falling prices. Synthetic diamonds also significantly damage the natural diamond market. That's interesting to me because nobody's really publicly said anything about lab-grown diamonds damaging the natural diamond market. And I predicted this when the lab-grown diamonds hit the market. We'll get into more of that in De Beers in a second. The Chinese market also is sluggish. Trading was slow at the Jewelry and Gem Asia Hong Kong show. So that's interesting. Normally with us, when we have loose or mounted goods and we need to move them and the U.S. market is slow or down, we will send those goods to our partners in other countries and other places of the globe that can sell for us. So many times a year we sell in Belgium, Hong Kong, and Israel because we will get better numbers out of those areas of the world than we do here in the U.S. So when the U.S. market's down, we will utilize other areas of the globe to get higher return or better numbers on our loose diamond goods and our finished goods. So the RAPI index is down about 2.4% on 1 carat polished goods. So that's, again, another decrease. Here's what I can say for June, the 30-point market, so 30-pointers are down about 0.8%. The half carats are about 3.4% down. The 1 carat's 2.4%, and anything above 3 carats are down about 0.9%, which at a year-on-year, it's double digits except for the 30-pointers. So 23% on the half carats, 23.9%, almost 24% on the 1 carats, and 15%, almost 16% on the 3 carats. That's a significant drop. So going back to the synthetic market damaging the natural diamond market, this is partly to blame. A lot of the blame for that is De Beers. Ironically, because I got an email actually from De Beers the other day that the De Beers reduces prices at the second consecutive site. So the site holders, meaning that they've reduced prices now 2 times, and I think this time they reduced them 15% in order to drive business because there's a slump in natural goods. Well, De Beers, part of the slump or that problem is because you came into the market in 2020 and went direct to market, direct to consumer at $800 a carat for lab-grown goods, cutting out all of the other growers that were in the business prior to you guys launching. Now, De Beers, I'm sure you were already in the marketplace, developing the technology, working on it, just didn't introduce it or bring it to market yet until you were ready. And I'm assuming to make sure that you could undercut all the other growers and manufacturers of lab-grown diamonds. Well, what you did here is now you forced the market in the natural goods down, and you've also forced the market in the lab-grown goods down because there's probably other growers that can do it better and cheaper than you, and they had to in order to compete with your $800 per carat pricing. So now you don't have a demand issue. We can meet demand from natural and lab-grown. The problem is a lot of the population is moving to the lab-grown diamond goods because they're a lot less expensive and you get a lot larger stone. So It's like if you take a look at the car companies and manufacturers and the car industry, and you have the same amount of buyers each year, and those buyers are now not buying natural goods, right? Or a specific car, and they're going to a different brand of car that is, 70 to 80% cheaper, but you gain the same benefits from a normal car. You've now transitioned all those clients or customers over to a different vehicle, lab grown, on a much thinner profit margin, much thinner asking price, much less expensive to manufacture than natural goods. So what's going to happen there is, right, your natural market's going to drop because there's not many people looking for that, and your lab grown market's going to go up. It has for us. I mean, year to date last year, we were 30% of people were asking for lab grown goods. This year, we're like at 50% looking for lab grown goods. The problem there is our margins on lab grown goods are tiny compared to natural goods. So the volume isn't the volume may be there, but the profit margin's not, and the price on goods isn't. So it's going to hurt both sides of the fence. Lab growns have also come down, and naturals have come down. So my suggestion is, I hope De Beers can get with somebody like Martin Rapaport and talk about leveling these prices out, working on something that the natural goods can sustain at a level price and lab grown goods can sustain at a level price. Because at this rate, it's going to continue to drive the market down. So that's what I've got for the state of the market for diamond goods. If you guys like the content, do me a favor, hit the thumbs up button, hit the bell to subscribe to the channel to get more videos into your email or your YouTube profile. And as always, guys, I appreciate you watching.